A warm welcome to you, my dear children. Welcome to Business and Accounting Studies. We are in Unit 4, which we started in the previous lesson, the previous session, and we are halfway through the lesson already. We are halfway through. So in this session, I expect to finish the lesson, Unit 4. That is Introduction to Accounting. Children who got together with me in the previous session, you must remember that we talked about several basics, fundamental things in accounting, about accounting. Yeah? I'm sure that you remember. Let's see whether you remember, whether you have memorized these important things clearly. We talked about accounting and what is accounting. When I say what is accounting, I mean the definition of accounting. The definition. One of you, I'm giving you the opportunity to tell me what is accounting now. One of you can tell me the definition of accounting. Why don't you tell me? Yes, you. Yes? Accounting is the process of? Correct. Accounting is the process of providing information, financial information. Not just any information. Financial information. Children, we provide financial information to the interested parties, right? There are many parties, as well as internal parties. There are external parties, interested parties who are interested in a business. Okay. I want you to tell me one word for interested parties. Parties who are interested about a business, interested in businesses. One word. One word. Stakeholders, that's right, very good. Stakeholders. So accounting is the process of providing information, financial information to the stakeholders of the business. For what? What for? For their decision-making process. For them to make their decisions. You remember, right? You remember. You must remember. This is the basic definition of accounting. Right, we'll repeat. Accounting is the process of providing financial information to the stakeholders of the business for their decision making. Good. Then we talked about objectives of accounting. Again and again, I'm giving this gesture for you to grasp what objectives are. Objectives are aims or purpose of something. Now tell me, what is the purpose or aim, or otherwise we can say objective of accounting. You tell me, what is the objective of accounting? Why do we do accounting? Some businesses are legally bound to maintain accounting records, to do accounting. Okay, forget about that. I'm gonna ask you the main objective that we discussed in the previous session. What is the main objective? The main objective. Tell me. Providing information. Good. Providing information to the stakeholders. Financial information, not just information, children. Financial information to the stakeholders of the business for their decision making. There were sub-objectives. We talked about 4 sub-objectives. Can you remember? Tell me at least 2 sub-objectives. Yes, to know the profit or loss of the business or financial performance of the business. to, correct, to know the financial position of the business. All were displayed very clearly, and I made the necessary explanations in the previous session. Now we are gonna take the lesson from that point onwards with the basic understanding of accounting. Right? Okay, good. Children, then I taught you that there are 5 main elements. 5 main elements in the accounting process. Okay. Yeah. Yeah. Name them. Name them. Assets. Okay, assets. Okay. Then liabilities. Good. Capital. Income and expenses. Right. Afterwards, we talked about assets. That was the last part of the previous session. Yeah, we talked about assets and the categories of assets, how assets are divided, what is in this side, how assets are categorized, the 2 main groups of assets, current assets and non-current assets. Good. Current assets are short-term, non-current assets are long-term. From that point, we jump on to liabilities. We jump on to liabilities. It is actually not a jump, it's a organized step-by-step process. So we step into liabilities. All right, let's learn what liabilities are. Okay, liabilities. The children who got together with me in the previous sessions, now we have come past 4 lessons. Okay, background of business, business environments, 3rd lesson, business organizations, and this is the 4th, introduction to accounting. If you were with me in the previous sessions, if you were watching me, you already know what liabilities are. Yeah? You already know. Yes, you already know. For those who don't know, I'll just give a brief explanation about liabilities. We have a definition on the screen. Do we have a definition? Let's see. Almost every business has liabilities which are obligations of the business. Is that a definition? No, that's not a definition. We'll come up with a definition as always. Almost every business has liabilities which are obligations of the business. I want you to notice this word. This word, children. Obligations. They are like, what is the meaning of obligations? If I don't know, if I ask you, what is the meaning of obligations? Liabilities are obligations. Can you tell me? Obligations are, children, obligations are responsibilities. Something that you cannot escape from. You're bound with these things, with these, what can I say? With these affairs. Bound with these affairs. You can't escape from them. So liabilities are such things. Okay. I'm going to give you the definition. Almost every business has liabilities, yeah, which are obligations. Yeah, we already know that. We can come up with something like this for the definition of liabilities. Liabilities are payables of the business. payables of the business. Payables. You have borrowed money from somebody, you have borrowed money from a bank, a loan, you have purchased goods on credit, you have not paid. So you have to pay. Bound to pay. Payables of a business. Okay. These liabilities are generated as a result of a past transaction. A past transaction has generated these liabilities in the business. Let's take your business. In your business, do you have liabilities? Your father's business, your uncles, your brothers, your cousins, whatever, whoever, doesn't matter. Ask them whether they have liabilities. If they do not understand the word liabilities, don't say obligations. Don't say obligations. Use the word loans. Ask them, hey, hi, I'm just curious. Do you have a loan that you should pay back? Have you taken a loan from a bank to run the business? Just ask. You will learn a lot of things. So loans are basically liabilities. I'm not saying liabilities are loans, but loans are liabilities. So I'm asking you to keep the entire definition in your minds. Memorize this. Okay? Don't get confused. Liabilities are payables of the business. Okay? These liabilities has been generated past transaction. That has been generated as a result of a past transaction. Or you can say has been generated from a past transaction. Should be paid back. Those are liabilities. Children, let's find out the characteristics, shall we? Characteristics. Characteristics. Okay. Generated from a past transaction. It's right here. Liabilities are generated from a past transaction. They bring an obligation to the business. They bring obligations. I taught you what obligations are, and you know what obligations are. I'm not going to repeat. Yeah, okay. I'm just saving time. You already know obligations, what obligations are. Okay. So liabilities are obligations to the business. Then they result in outflow of economic resources. I'll just explain this one. Outflow of economic resources. Can you remember when we discussed about assets and characteristics of assets? Yeah? Can you? You must. Children, memorizing is one of the key points to ace the exam, to get through the exam successfully. Memorizing. Memorizing clearly is the most important. So if I ask you whether you can remember the characteristics of an asset, business asset, can you tell me? Yes, you, Puta. Yes. Can you tell me? All right. Correct. Yeah, good. Assets are also, business assets are also generated. They are also generated from a past transaction. Okay. Second characteristic, they bring economic benefits to the business. They help to generate economic benefits. Assets. But in this case, children, liabilities help to, or liabilities result in creating an outflow of economic resources. They create an outflow, not an inflow. They create an outflow. Okay, not an inflow. Liabilities. What does it mean? It means, children, when you have liabilities, you have to pay them back. To pay them back, you have to spend your cash. You have to spend your money, not your money. The business has to spend the business money. Maybe cash at hand, or maybe cash at bank. From the cash at hand or from the cash in your bank, you have to pay back the loans. Sooner or later, you must pay them back. That's what is meant by outflow of economic resources. Here the economic resources refer to cash. You have to pay the liabilities back in cash. Okay, that's what it means. Cash paid to settle the liabilities. Okay, that's it. Shall we move on from liabilities and see what more to come? Yes, we shall. In this slide, I have shown you some examples for liabilities. A business loan is a liability. You see how the loan, liabilities have been, how the liabilities of the business have gone up and down throughout a period of time. Keeping the liabilities of the business in a controllable level, or keeping the liabilities of the business under control. When I say under control, I don't mean that you have to be afraid of them. All right, most of the businesses have used loans in their business processes, in the business operations. You don't have to be afraid of liabilities. All right, as I said, most of the businesses do not use only owners' money or owners' funds to carry out their businesses. They largely, in a large scale, most businesses use liabilities and loans for funding. Okay, so that's how liabilities can be explained. Moving on, so let's look at what liability categories are. As you can see, the same categorization, same as the assets categorization. We have non-current liabilities and we have current liabilities. Non-current and current. Liabilities are categorized into two main sectors, two main groups: current, or this side non-current and this side current. Non-current liabilities and current liabilities. No need to say that current means short-term liabilities and non-current means long-term liabilities. Why did I say there is no need to say, there is no need to mention? Because children, in the previous session, when we were talking about assets, we learned current assets and non-current assets. Same categorization in assets too. Same categorization comes to the liabilities too. Liabilities too are categorized in the same way. Non-current and current. Okay? And I taught you, you learned that current liabilities means, current means short term. Short term. Right? Short term liabilities. And non-current means long term. Shall I write less than 12 months here? So it's easy for you to remember. Short term means, children, these liabilities exist in the business for a short period of time. Very short period of time. Less than 1 year. Less than 1 year. Okay, not more than 1 year. That means the liabilities must be settled within 1 year. You can't drag them for a long period of time. Sometimes these liabilities must be settled in weeks, sometimes in days. So very short term liabilities. I will write less than 12 months. Should be settled in less than 12 months. Should be settled in less than 12 months. Is it visible to you? Current liabilities. Just for your information, for the students who are getting together with us in this session, who have not watched the previous sessions, I will write current liabilities means short-term liabilities, and less than 12 months. We have time to settle these liabilities less than 12 months, right? Not more than that. All right. So first current liability is bank overdraft. Second, we have creditors. Yeah. Third, we have bills payable. And fourth, we have outstanding expenses. Let's check out what bank overdraft are. I'll just explain this at this point. So it is easy for us to move on with our accounting lessons in the future. Because we are going to get bank ODs or overdrafts frequently, right? With our upcoming lessons, we are going to get this thing. We are going to come across bank ODs often. Let me explain it to you. What is a bank overdraft? Now, I mentioned one word when I was talking about bank overdraft. I said bank ODs. That is another term which you can use for overdraft. That is the short form of overdraft. Overdraft. OD. Children, an OD is a short-term liability, short-term loan. That's why it comes under current liabilities. It's a short-term loan provided to the business by banks. Banks provide these facilities, overdraft facilities or ODs, to businessmen. But in order to take an OD, in order to enjoy this facility, the businessman must have a bank account. I should have a bank account. I should have a current account. A current account. Okay? Okay. To get this very clear, we'll use an example. Okay? Right. Let's say I'm a businessman. I am a businessman. Okay? This is me. Happy face. Okay, this is me. This is the businessman. And a sole trader. Okay? A sole trader. He has a business. He has a business, let's say, a mobile phone shop. The business is a mobile phone shop. Okay? Yeah. And I order my goods. My goods are mobile phones. I order my goods from my agents, such as Samsung, Huawei, Oppo, Vivo, Apple, Nokia phones. I order from my agents. Okay. Now I place an order, or I order a new stock from my agent, and the order is worth 100,000. Okay. There is an agent, supplier, who supplies the phones for my shop. Right? I order goods from this agent. The order goes for 100,000. Order is 100,000 rupees stock. Okay. Order is 100,000 rupees stock. Right? I'm not going to pay him with cash. I will write a check. I'm going to write a check. A check. I write pay agent, Samsung agent, 100,000 rupees. And I'm signing the check, handing over the check to the agent. Alright? I'm paying this agent by using a check, 100,000 rupee check. So the agent goes to the bank to get the money. And the bank is right here. Which color do you want for the bank? Shall we use orange color for the bank? Like Sampath Bank? And the bank is right here. This is the bank. Okay? This is the bank. Red. Purple for the bank. This is the bank. Right? The agent goes with a check to get the money, to get 100,000 from the bank. But in my bank account, I have a bank account, okay? In my bank account, I have only 80,000. This is the bank account. Right? I have only 80,000. I must say something about the bank account too. I must say something about the bank account too. Now these bank accounts which businessmen use, which gives the facility of checks, these bank accounts are called current accounts. Children, current accounts. Bank current account. Okay? I have, as a businessman, I have a bank current account. In the current account, I have a balance of 80,000. You're going to learn about current accounts in the future. Very soon in the coming lessons, children. You're going to learn about current accounts, okay? For now, just think 80,000 is in the bank account and I have given a check of 100,000. Now, how is this guy going to take the 100,000 from the bank when I have only 80,000? That's a problem, right? No, children, that is not a problem. That is not a problem. When this check goes to the bank, when this check comes to the bank checks my balance and they realize that I have only 80,000. So they call me, right? And they ask, most of the time the bank manager asks, "Sir, Mr. Ranasinghe, you have issued a check of 100,000, but you have insufficient funds, not enough balance." That is what they say. You have insufficient funds in your account. The check is for 100,000, but I have only 80,000. When I get the call, I already know that I don't have 100,000 and the bank is calling me to confirm that whether to pay this 100,000 or not. I advise the bank this manner. I say, "Mr. Manager, please pay that 100,000 by ODing my account. OD my account and please pay that 100,000. Voila, it's done. I got an OD. Simple as that. So what the bank does is, bank adds another 20,000 to this 80 and makes 100,000 to pay for the check. What the bank does is, bank adds another 20,000 from the bank, from the side of the bank, they add another 20,000 and make this 100,000. The shortage of money is added by the bank. Now I owe my bank 20,000. That is an OD for my business. There you go, children. Overdrafts. Remember, I must pay the money back. This 20,000 must be put back to the account within few weeks, maybe even 1 week. It depends. Sometimes the manager calls again. Hello, Mr. Ranasinghe, your overdraft. You have to settle your overdraft. Then I go like, oh, all right. Give me 2 days. Give me 3 days. I'll put in the cash tomorrow. That's how it happens. It always should be settled within a very short period of time. Okay. All right, children. So that is about bank overdrafts. Bank overdrafts. Okay. So we talked about overdrafts. Yeah. And we know that it's a current liability. Done. We know that it's a current liability. So what else do we have? We have creditors. Creditors means agents, such as this agent. If we do not pay them for the goods that we purchase, that is a credit purchase. Or in other words, we buy goods from our suppliers and we don't pay them then and there. We don't settle the money then and there. It's a credit transaction or a credit purchase. Then our business is owing 100,000 to these suppliers. These suppliers then become creditors to us. Creditors, short-term liabilities. Creditors. Or there's another word, trade payables. We call them trade payables. We call them trade payables. All right, there you go. Trade payables or creditors. Short-term liabilities, children. Then we have bills payable, electricity bills, water bills, telephone bills, internet bills, your Wi-Fi bill not paid. Last month bill is not paid. Your Wi-Fi connection is cut off. It becomes a current liability. You must pay it back before the next month. Right? Liability. Must pay the amount back to the electricity board or to the water board or to the Sri Lanka Telecom, Wi-Fi. These bills, if they are outstanding or if they are unpaid, they become current liabilities. Finally, we have outstanding expenses, other expenses which we haven't paid. Okay, so all our current liabilities must be settled within a short period of time. Just remember, less than 12 months. Okay, right. Non-current liabilities, or we say long-term liabilities. That's what we say, long-term liabilities. Long-term liabilities. Long-term liabilities. We can take more than 1 year to pay them back. No issues, no problem. More than 1 year. To settle. We have only one non-current liability in your stage, O-level stage, children. Long-term liabilities and non-current liabilities. For these liabilities, we have only one. Those are bank loans. Bank loans are the only non-current liabilities that your syllabus has included. Sometimes mortgage loans also can come. Mortgage loans, that is also a loan which gives us a time period more than 1 year, sometimes 10 years, sometimes 15 years even, sometimes 20 years even, to pay it back. Big loans or larger amounts and long period of time in order to settle long-term liabilities. All right. Current liabilities, non-current liabilities. We are moving on from liabilities to equity. Equity. All right. Let's see whether the definition is given. If the business has liabilities, a part of its assets has to be used to settle those liabilities. After the settlement of such liabilities, the assets that remain belongs to the owner. I'll make it easy for you, okay? I'll make it easy for you, easy to understand, easy to remember, just for the sake of memorizing. We have discussed about, I have spoken about this thing before in the previous lessons. If I give you this word, you will remember. Children, equity means capital. Equity means capital. Now you remember. Capital is the amount of resources, money and the other resources invested to the business by its owners. Capital is the amount of resources, money and the other resources invested to the business by the owners. Owner or owners. We have invested to the business. Our money, owners' resources invested to start a business. E is called capital. Simple, right? Example. I'm again the mobile phone shop. This one. Okay. I myself as a businessman, if I invested, let's say 100,000, no, it's not enough. Let's say if I invested, I have invested 500,000 to start the business. Let's write the 500,000 somewhere over here. If I have invested 500,000 to start the business, out of this 500,000, that is mine. Okay. Out of this, just to make it clear to you, out of this 500,000, this is the invested capital by me. This is the invested capital by me. Out of this 500,000, 200,000 is cash. 200 is cash. 100 worth of equipments, my computers and my air conditioning machines for the showroom. I have brought in and put, I have given these assets to the business from my personal assets, from my personal properties. I have brought in 200,000 of cash, 100,000 worth of equipments, AC machines and computers and all. So here we have 3 and another 100,000 worth of furniture and another 100,000 worth of let's say motor vehicles. I have invested to the business, and then only I have started the business after all these assets have been invested. Okay, do you get it? That's how this 500,000 has been made up. There you go. 200,000 worth of cash. 200,000 worth of cash. 100,000 worth of equipments and furniture, another 100,000 of furniture and motor vehicles. The motor vehicle may be a bike worth of 100,000. So added up, we get, when we add up all the values, we get plus, we get 500,000. That is my capital, children. That is my capital, which I have invested to the business, to this business. Okay. So, equity means that capital of the owner. When all the assets are considered, business has many more assets. Now this business has many more assets. See, we have a bank balance of 80,000 and a stock of goods, mobile phones, showroom, right? Mobile phones are displayed, maybe worth of millions. All these assets, if we take as total assets, from those total assets, if you deduct your liabilities, the remaining assets are owner's equity or my capital that I have invested. That is what it says here. Got it? Good. The value of assets that belongs to the owners of the business is termed as equity. Fine. Here you go. This is what I explained. This is in your textbook, children. You can refer to this example. This is what I explained just now by saying, from total assets, when you minus the liabilities, the remaining is equity. The remainder is equity. 500,000 minus 200,000 liabilities. 300,000 is remaining, that is equity. All right, moving on. Okay, children, income and expenses. Let's learn about income and expenses. Incomes are the cash inflows. Inflows of cash generated by business activities. As we go on with the business, we incur or various transactions occur. The incurred or transactions occurred may result in inflows of cash or sometimes outflows of cash. Simply saying, due to transactions that we perform on a daily basis every day, there can be inflows or incomes of cash. Sometimes there can be outflows of cash. Then we can very clearly recognize in this manner, children, expenses are outflows of cash that a business incurs. Okay, we perform these transactions, spendings, in order to gain an income. Okay, example, let's say we rent a building. We rent a building, a premises, in order to start a showroom, start our business, to start a shop. That building belongs to somebody else. We are taking the building on rental basis. And we start our showroom, shop. Let's say the previous example we took, the phone shop. That phone shop is carried out in a rented building, and I have to pay 50,000 as the rent every month. The building is in a very nice location, just beside the main road, with good parking space and all. So the building is used for my business because all of these reasons, because of all of those reasons. Nice location, ample parking, beside the main road. That's why I'm paying 50,000 for the owner of the building to use that space, to use that building. So I'm spending this 50,000 as an expense in order to attract more customers to my business and to carry out my business successfully and to get an income from the business. So expenses are made in order to gain an income. Advertising. I put a billboard in front of my shop beside the main road, a big billboard, an advertisement. Okay? A bunch of girls and boys chatting with their phones, something like that. To put up the billboard, I spent 100,000. Looking at that billboard, very attractive, very colorful, young crowd, they know that there is a fine phone shop here, and this phone shop has all the latest mobiles, latest models, so they might get attracted. I can sell more phones. Then why did I put up that billboard? Why did I spend that 100,000? In order to attract more customers through that advertisement, through that promotion. Okay, I'm promoting and I'm spending for promotions in order to get more income. Okay, just for your information, but these things are, further explanations, but the basic, the simple definition for incomes is that an income is an increase of capital. Income is an increase of capital or increase in the owner's equity, which means more income that I get, higher my capital will be, or higher my profits will be, and profits are added to my capital. You get it? Profit is calculated in this manner. Profit is calculated in this manner. Income minus expenses. Yeah. Income minus expenses, okay, equals to profit. Right. Something that everybody is anticipating, everybody is waiting for, a profit. That is calculated in this manner. Income minus expenses. In that previous example, if I have sold phones worth of, let's say, I have sold phones worth of, let's say, I have sold phones worth of 200,000. Let's just take this figure. I have sold phones worth of 200,000 and got an income of 200,000. Okay. The value, the cost of those phones. I don't get phones out of the blue skies. Phones don't, fall from the sky, or Santa Claus don't bring the phones to me, to my shop. Phones has to be bought from suppliers, right? So to buy those phones, I spent 100,000. 100,000 worth of phones I bought. I ordered through my agents and they brought the phones to me. The cost of the phones were 100,000. I sold the phones for 200,000. Okay. What is my profit? 200,000 minus 100,000. 200 minus 100. Profit is 100. But if there are more expenses, now if we take the profit right now, the profit would be 100,000. But if there are more expenses, that's not good. Let's say we had to pay the building rent also. Building rent was 50,000. And we had to pay the salary of a salesperson. That was 25,000. Now how much is the expenses? Total expenses. Tell me, how much is the total expenses here? It becomes 150, 175,000. Now if you minus 175,000 from the income, the profit has decreased. Of course the profit has decreased. See, now the profit is, if you minus the total expenses, 200,000 minus 175,000, you have only 25,000 left. Hasn't the profit decreased? It has decreased by a large amount. See? Decreased. So, more expenses you do, less profit you have. Okay. What I mean here is, children, expenses decrease profit. So expenses are a reduction of profit. Profit belongs to the owner. Profit gets added to my funds. Profit comes to my pocket. So more expenses means less profit, less equity. In the On the other side, we have incomes. If I increase my income, let's say I increased my income to not 200,000, I increased it to 275,000. I increased my income, which means I sold more phones, or I sold phones for higher price. I sold this stock for a higher price. So I generated, or I got more money, more of an income. This time I got 275,000. Okay, 275,000. Now what will happen to the profit? Let's see what will happen to the profit. 275,000 minus total expenses. How much is the total expenses now? 175,000. Income is 275,000. Again, I will get a profit of 100,000. If my incomes increase. Okay, again I will get a profit of 100,000 likewise, like the previous time. Profit is this. So what do you realize? If incomes increase, profit increase. But if expenses increase, profits decrease. Simple, right? A word of advice to you. You have two options, two choices. Either you increase your income to increase the profit, okay, or you decrease your expenses. Simple, right? Either you increase your income, if this gap is the profit, if the gap between my hands is the profit, to increase the profit, either you increase the income or you decrease the expenses. Right? You're going to learn furthermore about incomes and expenses in the next lesson, children. So just remember, incomes and expenses. We'll come up with a definition for incomes. Inflows of cash. Inflows of cash. Right? Which increases equity of the business. Which increases the equity of the business. Then obviously, very simply, you know what would be the definition for expenses. Outflows of cash which decreases equity of the business. There you go, children. Incomes and expenses. Right, so with this part, my dear students, we end today's session and the lesson number 4, unit 4, Introduction to Accounting. Just for your information, a quick recap of the things we did today. We learned about liabilities, categorization of liabilities, current liabilities and non-current liabilities. All right. Equity, how equity is formed, how equity is calculated, and incomes and expenses. Incomes and expenses. So, with all that, we end today's session, children. This is Unit 4, the 4th lesson in your textbook. Today we finish Unit 4. I hope to see you soon with the next lesson, that is the 5th lesson, Unit 5, Accounting Equation. We are going to learn how these assets, liabilities, and capital, incomes and expenses, how they are related to each other. Good to have you with me, and I hope to see you soon. Thank you very much.